Hello and welcome to Asking for a Trend. I'm Josh Lipton. It has been a busy day on the earnings calendar as the stock market rebounds on the day. We're tracking the key movers in after-hours trading from Robinhood to Qualcomm to Snap. We've got it all covered. Time for more earnings because we're checking in now on some consumer-facing stocks. Yahoo Finance's Brooke DePalma joins us now with the latest quarterly results for DoorDash and Dutch Bros. Brooke, let's start with DoorDash.
Yeah, pretty significant sell-off happening right now in after-hours trading for DoorDash. And that's largely because of this key earnings miss that we did see the company post. Adjusted earnings per share came in at 55 cents. The street was looking for 68 cents, so about 13 cents lower than what Wall Street had expected going into this report. And also their adjusted EBITDA outlook for Q4 also came in at the lower range, perhaps, of what Wall Street was looking for. For that key metric, Wall Street was looking for a Q4 outlook forecast of about $802.7 million. The company now expecting a range between $710 million to $810 million. It's really sort of far less in that lower end of the range, but maybe what Wall Street was looking for. And the third thing here that might be selling off the stock list after hours trading, so we are getting some reports on some stock transactions inside the company. DoorDash director Andy Fang reported a series of insider stock transactions to the SEC, about 30,000 shares, equating of about $7.33 million there. So those three factors aside, DoorDash looking pretty good. The company did beat when it came to revenue. Also, their marketplace gross order value had a slight beat. Their total orders came in for the quarter at 776 million. That was compared to 771. And also their Q4 outlook when it came to that gross order value for their marketplace also came in a bit higher than what the street expected. But that adjusted earnings, that adjusted EBITDA outlook, and also this report of some sales, stock transactions as well, perhaps bringing down shares this afternoon.
What about Dutch Bros? Because that's a different story. I see that one's popping about 3%.
Yeah, different story there, right?
Yeah.
So this is a coffee chain that really has been growing quite rapidly, and they've been seeing pretty significant response from consumers. We did see yet again another quarter of same-store sales growth, and pretty significant in this sort of environment, especially. The company did see same-store sales growth of about 5.7%. That was higher than the 1.1% growth when it comes to same-store sales than the street had expected. It also beat on both the top and bottom line when it came to adjusted earnings and revenue. And this is a company that continues to push forward, growth plans, and also thinking about their fiscal year outlook. They also upped it yet again. They now expect same-store sales growth for the full year to come in the range, or rather be approximately 5%. And previously, they had about 4.5% growth. And this is far different than what we're seeing from low single digits that other coffee chains are reporting out there. And so clearly, Dutch Bros doing something right in this environment.
And you visited Dutch Bros.
I sure did.
What did you think?
Phoenix, Arizona.
Yeah.
I mean, it's a different experience. It's drive-through only. They have these energy drinks. They're really catering towards more of like an espresso drinker. Their afternoon is where they make a good bulk of their sales, and now they're testing out food. I mean, it's a growing chain. It doesn't have that many locations, but it definitely presents a different experience than maybe what we're used to here on the East Coast.
All right, stock higher after hours. Thank you, Brooke. Appreciate it. Stick around. Much more Ask for a Trend still to come. Unity shares jumping more than 18% after beating earnings expectations and raising guidance, signaling continued momentum powered by its Vector AI ad platform. And join us now with more. We got Unity CEO and President Matt Bromberg. Matt, it is great to see you. So you reported results, Matt. Investors sure liked what you had to say, Matt. Your stock soared on that report, but walk me through that report. What are you seeing in the business, Matt?
Yeah, thank you so much for having me today. It's good to see you. When we were together last quarter, we talked about how what we believed we were at an inflection point for the business, that we could see that we were really poised to be able to begin delivering long-term sustainable growth. And as we sit here now, having gone through the third quarter, it's clear that that's precisely what was happening. We had a really strong quarter. We beat both on revenue and EBITDA, both consensus and our own guidance substantially. And we had strength across our entire business. Our advertising business was up 11% quarter over quarter. Our subscription software business, the creation of video games, was up 13% year over year. So we really did see some really broad-based strength across the whole portfolio.
You know, Matt, when I talk to analysts who cover your company, and we talked about Vector, your AI-powered ad platform, right? They'll say, boy, Matt has some real margin growth potential there. But I'm curious to get your take, you know, as you look there, Matt. I mean, what are the opportunities and obstacles that you see?
Yeah, we've been really proud of the team that's built Vector. Vector AI has been proven to be incredibly powerful for our customers. It is delivering more and more value each month, enabling them to acquire new customers into their games in a really efficient way, and that's been driving their spend with us. So we're really pleased there. And it is true that historically, advertising businesses like this are very high margin businesses. So if you can grow them substantially, there really is a lot of opportunity for margin expansion over time.
You know, Matt, you of course, you give tools to developers to create games, but you've moved into other verticals. And I'm just interested, one, get your sense of how that's going, and two, what that could mean for your growth and profitability over time, Matt.
Yeah, the part of our business outside of gaming is incredibly exciting for us. In fact, in terms of our software business, it grows even faster than our core gaming subscription software business. It's the fastest growing subscription business we have. And that business is selling our visualization tools, our tools for creating interactive applications really broadly. We're a leader in selling automotive companies, especially in Asia. They design their in-dash experiences in cars with Unity. We sell visualization to manufacturers, to create virtual shop floors, to retailers, to create virtual retail environments. So that business is really booming for us, and it's truly exciting.
You know, more broadly, Matt, there is concern about the consumer. We do have a cooling labor market. You know, what could that mean for your company moving ahead to the extent that we did see consumer weakness in 2026?
Yeah, look, we're all rooting for the consumer and hoping that some of these disruptions will pass quickly. I think the important thing to remember is that historically, video games fare really well during periods of pressure for consumers. On a kind of hour-by-hour basis, it's a really good deal to play a video game, and that's especially true for mobile games, which are, and most of our customers are making free-to-play mobile games. Free is about as good a value proposition as you can have. So we've seen historically some real durability of our business, and we're not seeing any pressure right now on our consumer.
Your general take, Matt, you've been in the business a long time, on the video game industry. As we roll into 2026, Matt, how excited, how encouraged are you by what you're seeing just broadly in the industry? Got GTA 6 coming. What's on your radar?
Yeah, I mean, it's an incredibly exciting time for us. Look at how the Switch is selling. GTA 6 is going to be a monster. We're getting some real vibrancy and new handsets and phones into the market that we're seeing. I think what we've seen is that when we make great devices and great games, consumers are still flocking to video games, and I think that's going to become ever more true in the years ahead.
Final question, Matt. I feel like I have to ask, because there's probably gamers watching right now. You've been in the industry a long time. Any games you're playing, Matt, that you'd want to call out right now?
Gosh, there is an explosion of incredible made with Unity games out there. I would say there have never been more new independent games made by Unity developers at this time than ever. I'll just point you to one game called Peak. It's a kind of a peak climbing adventure game. It was built by a few developers in a super short period of time. It's already become one of the best-selling games in the history of Steam.
Matt, always great to see you. Appreciate your time. Thank you.
Good to see you again. Thank you for having me.
It's been a busy afternoon for earnings. Here are some of the key movers to watch. Check out shares of Snap soaring on third quarter results and a major AI deal. Parent company of Snapchat announcing a $400 million deal with Perplexity AI. Perplexity Search will be incorporated directly into the social media platform. Third quarter results beating expectations. And on top of that, Snap also announcing a $500 million share buyback program. Meanwhile, Elf Beauty shares, they're plunging. It's after reporting second quarter net sales that missed Wall Street's estimates, while earnings topped expectations. But looking ahead, the beauty company providing a lower than expected forecast for full year earnings and revenue. Elf also providing an adjusted EBITDA outlook that missed expectations. And shares of Figma jumping on earnings. The design software company's results topping estimates on the top and bottom lines. And what's driving the move is the outlook, adoption of new products, leading the company to raise its full-year revenue forecast. Stick around, much more Asking for a Trend still to come. ADP's latest private payrolls report out this morning showed the economy added 42,000 jobs last month. Yahoo Finance Fed correspondent Jennifer Schonberger sat down with Fed Governor Stephen Miron to discuss how he's looking at this report and his outlook on the labor market.
We always have to be cautious of reading too much into any one report, and that's going to be even more the case when we have a government shutdown, that we're not getting the data that we need to make monetary policy. Now, we are getting alternative data from a variety of sources, like the data that we got this morning from ADP, which is a welcome surprise that it came in a little bit better than expected. But in the context of the overall picture of the job market, it seems like the pre-existing trends that were in place before the government shutdown, the labor market, seem to be continuing, at a similar rate. You continue to see modest potential overall job creation. You continue to see moderation in wages, and you continue to see indications that labor demand may not be as strong as we'd like it to be from a cyclical perspective. All of that, to me, is an indication that that rates could be a little bit lower than where they are now.
How much of this that's driving the job market right now is structural versus cyclical? We know there have been major policy changes that have come from the administration, which take time to work through the economy. What's your sense of that? And do you have the tools, if it is structural, to deal with that?
Yeah, so a lot of the changes to the number of job creation, to the levels of job creation that would occur as a result of policy changes like immigration are what we as economists would call output gap neutral, right? Economically, the role of monetary policy is to balance supply and demand in the economy, and to make sure that you don't have demand so far outstripping supply that you get, upward spikes in inflation, or that demand isn't cratering relative to supply so that you get downward spikes of deflation of the type that you have in a depression-like environment. And so the goal of monetary policy is really to balance supply and demand. Now, if you have changes in, let's say, population growth because you either have a policy of large-scale mass immigration or you have a policy of closed borders and net zero migration, that's going to be what we would think of as typically, in my opinion, output gap neutral. And the reason that's the case is that when you have an additional person in the economy, they're generally consuming as well. They're working and they're consuming. And so from an output gap perspective, it's not clear that there's a very big role for monetary policy to play, because it's not the case that supply or demand are moving by very different amounts. They could be moving by very similar amounts. And so some of the low levels of growth are a result of changing border policy. If you have an economy in which you're throwing in large numbers of new migrants, of course, the overall job number will be flattered by that. And if you stop that, the overall job number will reflect stopping that. But that's not necessarily something that monetary policy responds to automatically.
And sort of building on that, the president has gotten many companies to invest billions of dollars in this country. We're going to be seeing investments in technology, in AI, in factories at the same time. The tax bill has been made law. We've got 100% expensing on PP&E and factories. How much job growth could we see from that? And what is the timeline on that? Is that a 2026 story? And again, kind of going back to those longer term structural versus cyclical trends, how are you viewing that as it relates to the labor market and setting policy? Yeah,
so look, I do believe that the supply side of the economy matters, right? I'm not, I don't exclusively look at either just the supply side or the demand side. I think that they both matter. And as I said a moment ago, the role of monetary policy is to balance them. And I think that there's a whole slate of expansionary policies on the supply side that drive out the productive capacity of the economy. You mentioned some of them, things like the full expensing provisions from the tax bill that was passed over the summer. There's now a huge tax incentive to invest in new factory equipment or to invest in factory structures. I do expect that to result in some additional investment demand. That additional investment demand pushes demand up higher in the short run, and a little bit longer run, it pushes the supply side of the economy out because you can produce more because you have more capital. And that's all stuff that matters when you think about the outlook and when you think about where monetary policy should be. But there's other elements that are pushing out the supply side too, and think about regulations. Regulations really shape the structure of the economy because they decide whether you can produce or not and what you can produce or not. So the industries that you have in the country, how big the industries are and where they're located, can all be a function of the regulatory environment. And as you change those, you can change the supply side of the economy too. And pushing out the supply side of the economy in those ways And sometimes it'll take demand with it, for instance, and the full expensing, right, will create investment demand. But in other things like regulations, it's not as clear to me that it pushes out the demand side as well, and it actually expands those output caps that I mentioned a moment ago that monetary policy should respond to. So I think there's a variety of policies that are affecting the economy. They affect the short run, they affect the long run, they affect both of them, and they affect the supply side and the demand side. And it's really important to be thinking about the ways in which those are happening and trying to disentangle them and how monetary policy should respond to that. And we typically think about monetary policy as responding to three things. It responds to the output gap that we talked about. It responds to the outlook for inflation, which can also be affected by these policies, and it responds to changes in the so-called neutral rate. That's the level of monetary policy that's neither restrictive nor accommodative. And so you'd want to be looking at all of these policies and trying to say, okay, what's it doing to each of those three things?
Breaking news, the government shutdown set to hit air travel in America even harder. Transportation Secretary Sean Duffy just announcing in a news conference that the FAA will be reducing air traffic by 10% at 40 major airports across the U.S. The cuts will begin on Friday morning. This comes as the government shutdown has now stretched to the longest in history, passing the 35-day mark. Federal Aviation Administration Administrator Brian Bedford saying about the decision, quote, "As we slice the data more granularly, we are seeing pressures build in a way that we don't feel if we allow it to go unchecked will allow us to continue to tell the public that we operate the safest airline system in the world." Airline stocks modestly lower in after-hours trading. Time now for what to watch Thursday, November 6th. We're going to start off on Tesla. Shareholders getting ready to vote on CEO Elon Musk's controversial pay package on Thursday. Compensation plan worth up to $1 trillion. The outcome could shape Musk's future at the company and test investor confidence in Tesla's leadership. Taking a look at earnings, it's another big day of reports coming from names like AstraZeneca, ConocoPhillips, and Warner Brothers Discovery. AstraZeneca announced results for the third quarter before the markets open. Analysts expecting Q3 will be harder to match after strong growth in the first half of the year, but management may still raise full-year guidance due to potential pricing cuts in China. Moving over to the Federal Reserve, we're going to be getting a big batch of Fed commentary on Thursday from multiple officials. This is coming after Fed Governor Stephen Myron told Yahoo Finance on Wednesday that he thinks policy is too restrictive and that it runs unnecessary risks. And finally, new mortgage rate data from Freddie Mac coming out on Thursday. The current rate on the 30-year fix sits at 6.17% and has dropped in 4 consecutive weeks. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet.